Welcome back, everyone. This is Personal Finance for Us. Today I am extra pumped because this is going to be the first video in our latest series, Investing 101. The goal of this series is going to be to give a general description of the most common assets people put their money in that have been proven over and over again to produce wealth. So first up for today is going to be single stocks. Let's get into the video. Company stock is effectively buying a small piece of a company's ownership. If you think about it, the opportunity to buy a piece of a company's ownership is kind of a big deal. We're way more likely to end up working for a Fortune 500 company than we are to actually create our own and be the CEO of one. So the opportunity to buy a small piece of that for the common working person, that's huge. Unfortunately, most people don't really think about stocks this way. They often kind of treat them like a lottery fashion. It's like, we've all been there, right? Like, we've had that friend or neighbor that says, buy stock X with no real rationale, and maybe we've heard of company X, maybe we haven't, but usually the rationale is some sort of speculative reason. If you take a more ownership style view of holding on to stocks, you think about them a little differently. A business really isn't that different from your personal economy. I mean, think about it, right? Your cousin that's got bad credit, has a marijuana problem, and loves to strip joint. He comes and asks you to borrow $200. You know, I know, and he knows you're never going to see that $200 again. Contrast that with your cousin that maybe's always been a little bit more entrepreneurial, and he's got a really good business idea and things are going, but he's a little hemmed up because he's run out of some money, but he has a purchase order. So he comes to you and he's like, cuz, I got this purchase order, I just need more money in order to be able to fulfill the order. Who are you more likely to take your chances on? That cousin? Sure. Could the business fall and you not get your money back? Absolutely. But he could succeed and get you your money back and then some. Stocks are exactly the same way. I mean, let's just face it. You know you're still taking a chance, but he's way less of a risk than Strip Club Cousin. If I had told you that Amazon's profits in 2019 were $11.59 billion, and in 2018 they were $10 billion, you'd hardly be surprised. I'm sure you can name at least 5 people with an Amazon Prime account, including yourself. We know that they've gotten into the streaming business. We know that they've bought Whole Foods. Life experience has told you that Amazon is a behemoth, and it's probably a company that you wouldn't mind owning. Now, what if I told you that Ford, despite being a major American company for a long time, has been struggling? In 2018, the company made $3.6 billion, which sounds good until you consider that that's half of what they made in 2017. And then last year in 2019, they made a sobering $47 million. Then coronavirus hit this year of 2020, and people the world all over had to stay inside and suddenly didn't need a new car anymore because they weren't going anywhere. How do you feel about owning Ford now? Truth be told, you're probably not surprised by any of this. You probably have just kind of heard that Ford hasn't been doing well. You probably heard that they had major problems with their double clutch system. You've probably heard that they decided to get rid of making a lot of their small cars and focus more on trucks and SUVs because they were making more profit that way. Just your daily life, again, has told you, and just picking up things and conversing with people, and maybe you've known someone that's had a hard time with their Ford. I've known a couple. Just life experience and just hearing news kind of suggested to you that Ford has been struggling. This is exactly the sort of thing you should be paying attention to when it comes to company stock. How's the company doing? How much do I interact with this company's products or services in my everyday life? Do the people I know love this company and love their products? Now, generally, companies will go along until they get to about a certain size and start generating some decent profits, And then they realized they could really use a lot more money to help propel more growth to increase their profits further. They may decide that they want to offer the general public a slice of their ownership. This is what's known as going public. Now we can buy our way into that company as they continue to grow. The more a company grows and the better the business gets, the more popular that stock becomes. You are probably already familiar with the concept of supply and demand. The more demand there is for something, the higher the price. Well, strong companies with strong profits have more desirable stock. Apple is a perfect example to illustrate this. I remember when Apple computers first came into schools, and they were absolutely terrible. They crashed all the time, and the only thing they could really offer was cool case colors. Although I did get to play Where in the World is Carmen Sandiego and the Oregon Trail, so I guess I'm grateful for that. But Apple never gave up, and they figured out how to market. Those colorful iMac commercials played constantly, and then they marketed the hell out of the iPod. To tell you the truth, there were actually better products than the iPod out there. Seriously. A friend of mine had put me on to a little MP3 player called an iRiver. It had a 1-inch color LCD screen, which was unheard of back then. And on top of that, it actually worked like a removable hard drive. You could plug it into your computer and you could literally put any file type you wanted, not just music, on there. Put it on the device, unplug, take it to the next computer, offload it there. Contrast this with everybody who was loving their iPods. When they tried to pirate each other's music and they'd plug into iTunes, it would, I know you guys remember, it would erase the memory. Meanwhile, I was able to pirate freely. The problem is, probably no one watching this video now had ever heard of iRiver, and that's where Apple won the battle. Now, if you had bought Apple at the end of 2002, you could have bought it for $14.33 a share, just after they had a major 40% price drop. This was cheaper than their initial public offering when they first went public back in 1980. Back then it was $22 a share. As of the day that I wrote this script, it was $8.20 in 2020. Apple had closed at $473.10 a share. So if you had $10,000 at the end of 2002 and you would have dumped it all into Apple stock after that price drop, you would have bought 697 shares. Apple had 2 stock splits between now and then. The first one, a 2-to-1 in 2005, which would have doubled your shares to 1,394. They then went on to have another split in 2014, this time a 7-to-1 split, which means you would have had 9,758 shares. If you would have sold them all on August the 20th of this year, of 2020, according to my fuzzy math, you would have cashed in about $4.6 million worth of Apple shares. Now, am I telling you to go run out and find some speculative penny stock and put every dime you have into it? No, absolutely not. But this illustrates how stocks and how long-term investing generally works. The younger and weaker a company is, the less investor confidence there is, and therefore the cheaper the stock. Today, Apple is a household name with tons of cash on hand, solid financials, and this means that it's a very strong stock, which means it's fairly expensive. This is how investors make money. One of my favorite people to listen to in regards to stock investing is Warren Buffett, and his philosophy is simply invest in the things that you already know. He, of course, is famous for loving Coca-Cola. He is also famous for avoiding tech stocks to some extent. As much as a business guy as he's been his entire life, he's still not really big on tech simply because he doesn't understand it. But he does understand that people like to chew gum and eat cheese and drink Coca-Cola.
The most important thing is to be able to define which ones you can come to an intelligent decision on and which ones are beyond your capacity to evaluate. You don't have to be right about thousands and thousands and thousands of companies. You only have to be right about a couple. I met Bill Gates on July 5th, 1991. We were out in Seattle, and Bill said, "You've got to have a computer." And I said, "Why?" And he said, "You can do your income tax on it." I said, "I don't have any income. Berkshire doesn't pay a dividend." He said, "Well, you can keep track of your portfolio." And I said, "I only have one stock." I said, and he says, "It's going to change everything." And I said, "Well, will it change whether people chew gum?" And he said, "Well, probably not." And I said, "Well, will it change what kind of gum they chew?" And not. And I said, "Well, then I'll stick to chewing gum and you stick to computers." I don't have to understand all kinds of business. There's all kinds of business I don't understand. But there's thousands of opportunities there. I did understand the Bank of America, and I'll be able. I'm able to do that. I'm able to understand some given percentage. But Ted Williams wrote a book called The Science of Hitting, and in The Science of Hitting, he's got a diagram, shows him at the plate, and he's got the strike zone divided into 77 squares, each the size of a baseball. And he says, if I only swing at pitches in my sweet zone, which he shows there, and he has what his batting average would be, which is 400. If he had to swing at low outside pitches, but still in the strike zone, his average would be 230. He said the most important thing in hitting is waiting for the right pitch. Now, he was at a disadvantage because if the count was 0-2 or 1-2 or so on, even if that ball was down where he was only going to bat 230, he had to swing at it. In investing, there's no called strikes. People can throw Microsoft at me and, you name it, any stock, General Motors, and I don't have to swing. And nobody's going to call me out on called strikes. I only get a strike called if I swing at a pitch and miss. So I can wait there and look at thousands of companies day after day, and only when I see something I understand and when I like the price at which it's selling, then if I swing, if I hit it, fine. If I miss it, it's a strike. But it's an enormously advantageous game. And it's a terrible mistake to think you have to have an opinion on everything. You only have to have an opinion on a few things. In fact, I've told students, if when they got out of school, they got a punch card with 20 punches on it, and that's all the investment decisions they got to make in their entire life, they would get very rich because they would think very hard about each one. And you don't need 20 right decisions to get very rich. 4 or 5 will probably do it over time. So I don't worry too much about the things I don't understand. If you understand some of these businesses that are coming along and can spot things on, if you can spot on Amazon, for example, it's a tremendous accomplishment what Jeff Bezos has done. And I tip my hat to him. He's a wonderful businessman. He's a good guy, too. But could I have anticipated that he would be the success and 10 others wouldn't be? I'm not good enough to do that. But fortunately, I don't have to. I don't have to form an opinion on Amazon. And I did form an opinion on the Bank of America, and I formed an opinion on Coca-Cola. Coca-Cola's been around since 1886. There's 1.8 billion 8-ounce servings of Coca-Cola products sold every day. Now, if you take 1 penny and get 1 penny extra, that's $18 million a day. And 18 million times 365 is 7 billion, 3 less 730 billion, or $6,570 million. So annually, $6,570 million from 1 penny. Do you think Coca-Cola is worth a penny more than Joe's Cola? I think so. So, and I've got about 127 years of history that would indicate it. So those are the kind of decisions I like to make. And you may have an entirely different field of expertise than I would have, and probably much more up to date in terms of the kind of businesses that we're seeing evolve. And you can get very rich if you just understand a few of them and understand their future.
All right, everyone, that will wrap up this first Investing 101 video. Again, I just want to recap and really drive home that when you're talking about buying stocks, you are buying into ownership of a company. So when you think about investing, really think about companies that you understand. Think about what makes a good company, and are they stable? Are they profitable? This foundation will help you invest successfully and help you feel less like you're taking some sort of crazy gamble with your money. This has been Personal Finance for Us. We out.